Hey, everyone here at the Investing Stuff You Should Know podcast. We're delighted to have d.mcilwaine with us today. I think I butchered a little bit, but it's close. And David comes to us from Colorado. I'm in Minnesota, so we both are experiencing some colder weather. But aside from that, David has a really kind of extensive corporate career, but also a vast experience in real estate. He's going to share some particular insights and things that he knows and has shared and has seen throughout his career. So David, thanks for being with us today.
Thanks, Johnny. I love hearing these introductions. It always makes me feel like this really nice, warm, experienced, knowledgeable guy.
We build it up, but I think also most of the guests we've been having, especially lately, David, they can actually put the punch behind the words. So that's who we're bringing on more and more of, and that's really exciting to have people of your caliber arrive and share your knowledge. So give us the obviously people want to know, well, why should I listen to David? And so a little background there, and then we'll jump right into some things that people came here to learn, to know and to learn and to grow in.
You bet. I got to deliver now, right? So here's the short strokes.
There's no backing out.
There's no backing out. I'm pot committed now. So I've got a 20+ year career in advertising on the buying and the selling side, the majority of it as a sales executive. And I led, at the end of my advertising career, 2 different sales forces, one in the Midwest for a division of Viacom, and then another for a tech startup. And the short answer is that after 17 years at one company and being responsible for $1 and $3 a company generated on a $500 million business, I hit budget 9 quarters in a row before the quarter started, which is phenomenal as a sales executive. Yes. Talk about being able to sandbag, but the reality is you can't, because you're always comping against your year ago, your quarter ago quotas, and you really can't sandbag it. So it was Herculean growth, and I was loving it, and the bonuses were great, and life was good. And then we merged.
Okay.
And in the course of 6 months, we went from having the Department of Justice stop the merger to approving the merger. And the month after the DOJ approved the merger, 1/3 of the staff was laid off, regardless of performance.
Wow.
My entire level was cleaned out. The guy that laid me off was cleaned out the last day. I literally hit my budget for Q2 the day I was laid off, which was the end of Q1. Fast forward 18 months. And I'm in the same position again. At this point in time, I'm going through a divorce. I'd spent my career on an airplane, had walked away from all of the things that are really valuable in life for the chase of the dollar, and,
yes, sir,
and holding on to the golden handcuffs I had. 18 months later, I'm in the middle of becoming a single dad. I'm the CRO for a tech startup. We close a Series B fundraising round. I come in the next day ready to hire 35 sales reps and our business plan to put the hockey stick in place.
Yeah.
CEO says to me, "Hey, guess what? We paid off our debt." And I said, "Hey, what debt?" I'm the CRO. I didn't know we had any debt. Why? Because the CEO and founder didn't tell anybody. A week later, you know it, I'm on the street or the beach or hanging out looking for a new gig. And I said to myself, I'd seen the story.
Did you feel betrayed on that personal level there, David? Did you feel betrayed and like really pissed off, or what was your own just kind of emotional state at that point?
Oh man. So in the first one, I could smell the guy's breath. Who was sitting across the desk. He'd been my competitor for 17 years. I loathed that guy.
Yeah.
And he said, "Hey,
if you notice in movies, just completely off point here. If you ever notice in movies, when they ever want to make a character particularly odious and like reprehensible, they always amp it up. They always show them eating. I don't know what it is about eating. They just discuss the viewer or your competitor, like you said. They show them eating, typically, particularly in kind of a gross way, and it just creates a sense of disgust. So yeah, that's very relatable, and that's it. That analogy is very
well. This
powerful.
Individual was kind, and he wasn't eating, but he had coffee breath. And he's a nice guy. I didn't dislike the person. I loathed my competitor.
Yeah,
he was a great guy, nice fella. He was trying to be authentic.
It speaks to your perhaps your competitive nature as a person. Perhaps some of that.
I am highly competitive, which is great in this business. Anyway, I did have all those emotions. I felt abandoned. I felt neglected. I felt ashamed. I felt scared. And in the first layoff, I had this huge 6-figure severance package that paid me out for a year. And I still was miserable because I had lost my DNA. 18 months later, it happens again. I'm losing my self-constructs as a corporate executive and as a leader. And it's not about performance.
All the things that make us like literally our identity is wrapped up in our job and how we perceive ourselves, which is, I mean, you could take this a lot of different ways. Like when people retire, they oftentimes pass on after a year or less, so it's extremely disruptive to the human body and the human psyche, from what I've seen and what I've observed in myself.
Part of my messaging, and I couldn't agree with you more, part of my messaging is that it's not a matter of if you get fired, it's when you lose your job. You may not get fired for cause. You may not get fired for behaviors. You're going to get laid off or lose your job at some point in time. And after I lost it for the second time in 18 months through no responsibility of my own performance and just through outside circumstances that I could not control, I sat back and I realized I'd watched my dad do the same thing in the 80s.
Yeah.
And I said to myself, one of my aha moments was, I will never again be in a place where I am not in charge of my financial destiny.
Yeah. Very powerful.
Led me to
realization. Yeah. So that's
Yeah.
bridge to real estate. So yeah, that's such a compelling story. Obviously a lot of emotion and real life things, and these things happen. And also it's kind of a story or a cautionary note for people out there. It's not one of fear, like to like inject fear into people, but also it's like, hey, be realistic about this life, the life out there. I don't care how good you are at your job. It's really, really likely. You're saying 100% probability, but very high that you'll get laid off, or your company will shift, or you will no longer be needed. So yeah, that just note that. So, but anyway, so stepping into the real estate. So you found real estate and it was compelling, and that allowed you to be more in the driver's seat and maybe snap off those golden handcuffs, if you would.
Well, not necessarily. I found real estate. I came in to be a flipper.
Okay.
And I had a fairly good net worth, and the divorce cost me more than I anticipated, and the market was different than I anticipated. And I learned quickly that flipping for me was not the path to success.
Yeah.
I decided that putting out that much capital and returning only a 10% return on that capital for the risk I was taking was not a sufficient risk-adjusted return for me. So I became an agent, and I floundered for a long time as an agent. I'm a corporate sales guy. I'm a corporate thinker, and I didn't go into commercial.
Oh.
And I was licking my wounds way too long. I sat on my haunches way too long. And then one day I'm at an investment seminar and I see somebody talking about scale of buying apartments. And he says, if you can buy one, you can buy 100. And I owned a couple of units at that time because I was smart enough to make some investments on my own. And I said to myself, hey, that's the exact same model that I used in the advertising world, and I was hyper successful at it. And within the course of a minute, I entirely changed my business plan, my vision, and my structure of my life. Within a year, I had become a general partner in 1,000 doors, and I had launched Mac Assets. And from there on, it's been
there's that hockey stick that you're trying to implement in that company a while back, huh? With that, or that startup that you're trying to do with this, hiring those all those associates. Here it is.
There's the hockey stick, right? Yeah. There's the hockey stick. There's the competition. There's the acceleration and the energy. I have all of that when I am engaged, and this business engages me like no other. But I want to talk more about this if not when 100% probability thing for a second. Yeah. Think about all the people you have in your life that have lost their job. And if you do the math, 1 in 2 marriages fails. And that's horrific numbers. And if you think about it, have you got 5 friends and 4 of them have lost their job over the last 20 years? 80%, pretty close. 70%, So it really is an if. It's not a win, it's an if in some way, shape, or form, unless you own your own company. And then losing your job equates to losing a key client. I've had a key client disappear and lose 80% of my revenue in one phone call.
That's a hard
And it's the same feeling. You
Yeah.
know what I mean?
Yeah.
And so
What's your, just to push back on that, because I'm also like all about entrepreneurship and I'm in real estate, David. What's your take on people that are like, oh, they're gonna like, push back? I'm like, well, what if the market changes, in your small business or whatever? What if it changes? And what if I lose a key client and I'm the CEO of my small business? Like, what's your pushback on that? Or what's your response to that?
it's the same response. You got to rebuild.
Yeah.
When you lose a job, you rebuild. When you lose a key client, you rebuild. The 20-80 rule says that, or the 80-20 rule, depending on how you look at it,
Yeah.
is that a micro composite of your customers deliver a macro of your revenue. And
So then
the people that I work with are sales executives, right? So I'm trying to talk about it in their language because it's the same thing.
Yeah. Yeah. And then, but the foundation of that, though, I'm just trying to drill into this just a little bit there, is like, if I lose my job and is it like, because I'm working for somebody else, it's a bigger setback? Or if I'm the CEO or the owner or the sole proprietor or whatever the structure it is, and I lose a key client and I lose, everything, let's just say just losing this opportunity or the market changes, I'm going to lose everything. What is the fundamental difference there between being in control of like the company or being the owner of the company versus working for somebody else? Have you thought about that piece? I'm sure you have.
Yeah, I have. And I try to think about control as analogous to a hula hoop.
Okay.
I can control the things. If I put a hula hoop on the ground and I stand in the middle of it, I can control the things inside my hula hoop. So if I'm the owner of the company, there are things I cannot control, like what the other person's what my competitor does, what my biggest client's spouse says to that client after we've gone to dinner. I can influence and I can affect and effect, but I cannot control it. And so what I would say to you is that it's the same rebuilding structure. And the argument here is not about the physical losing the job. The posture I'm making is that we all have to get up and rebuild time and time again. Yes. And if we're not prepared to rebuild and we don't have rebuilding in the back of our brain, able to come to our forebrain at any moment in time, we are going to suffer some negative effects and consequences.
Sure. And then the rebuilding, do you think you're more resilient when you're in charge of your own financial destiny?
I don't know that more is the right word. I'd say it's different resilience.
Sure.
Because I'm in charge of my own financial destiny. However, the Fed last year raised the federal funds rate by 300 bips in the course of less than a year. That killed my acquisition business.
Yes.
Killed it. It killed everybody's acquisition business. Had nothing to do with David. And the resiliency is how to adapt and respond to the marketplace. And it's the same if you're in corporate America or you're not. If you're an entrepreneur or in corporate America, you've got to be able to respond and reinvent and rebuild all the time.
That's a great segue into another piece that we haven't talked a lot about on the show, David. And that is, you and I talk about real estate or in real estate, some people are like, oh gosh, these guys are all just, real estate, they're just they're drunk the Kool-Aid. As a fundamental difference, something that you espouse is you like to stay, you recommend people stay in the stock market. Give us David's philosophy on that diversification of investments, some stock markets, some bonds, some real estate, like what does it look like and why, and how have you arrived at that?
You bet. Before I answer that question, I'm dying to know. You're the second guy in 2 days I've been on a podcast with who said this to me and asked me this question. Is that published somewhere that somebody's reading and saying David's a contrarian? Because I am a contrarian, so it's kind of funny.
So I got that actually partially from your bio that you submitted.
Yeah.
And so I just want to make that. So I don't know what the previous person said, but also I also think that as well. But when you're in the game, quote the game, if you would, of like, oh, you got to be real estate, the thought is, and this in sales. So I'm like spinning out too many different messages, like, oh, you should like, I'm real estate, but like stay in stocks and some other things, like stocks is my foil. Like, hey, like stocks, everyone, like assume everyone's in stocks and come over to real estate. So that contrast is, it's kind of there for like a paper tigers, but I need to like get you on the show and like, hey, let's be genuine, let's be frank about this. What is a good balance and why have you arrived at that balance in your professional view?
Love that question. So I am not a financial advisor. I don't have any certifications in money management. I'm not trying to sell you anything. I am here to share my experience and knowledge only. So now that the SEC knows I'm not trying to pitch a stock, here's what I would say to you. When I was an employee, and give me 3 minutes and you'll hear the answer. When I was an employee at a division of Viacom, my income was tied to radio advertising sales. My 401k was controlled by my company, which had stock choices that were very limited. My retirement was controlled by my company. My bonuses, my income were controlled by my industry and my performance. So I had everything in the advertising segment, and I would try to diversify into oil and gas, into durables, and the large cap, stock, small cap. But the reality is that when I lost my job, my diversification was very minimal because 90% of my net worth was tied up in my income. So I view this diversification not as just investment, but as a holistic approach. So you got your house, or you've got your cars, or you've got your possessions, or whatever your net worth is that you build it around. And then what's your income streams? And so the diversification, we can talk about it several ways. One of the things I think to myself is, if I just buy in the stock market, I'm buying the same thing. I'm creating a differentiation and a segmentation in the stock market, but I'm just buying publicly traded companies. That's it. I don't have control. I don't have knowledge. I don't have firsthand information. I have secondhand reporting that's required to be legal per the regulations of the SEC and the federal government. So my point of view is that you're not going to leave that market because that's the largest marketplace out there, but you have to have more than one marketplace you're involved in. So that brings up alternative investments. I'm not going to give a ratio that says you should have 70% in real estate, 30% in stocks. But the reality is, if you're an employed person, you're going to have money in your 401k. You're going to have money in an IRA. You're going to have money in your income. And you got to think about this holistically. So from that point, I quit picking individual stocks and I'm buying trackers. Right. I'm buying a SPDR. I'm buying an S&P index fund. I'm buying a Russell 2000 index fund. Why? I actually did an experiment on this. My son, and I gave my kids each $1,000 a couple of years ago. And I said to them, hey, pick some stocks. Yeah. My son picked Apple right before a split. Great. We're going to buy the FANG. Okay. My daughter's like, I don't know, Dad. You pick something. So what did I pick? I picked the SPDR. Yeah. To trend it against the NASDAQ, to do a real world experiment. For 3 years, we've been doing this. Yes. My son is losing to my daughter. Wow. The high flying Apple stock is losing to the marketplace bet. And so I believe that if you take the marketplace bet, you're actually getting a better risk adjusted return than if you buy the individual equity. There's a phrase that I uncovered one time that just haunted me. And I was making big money. And I had this question every month of how was I going to invest my money? Right. I couldn't invest it in a private equity stuff like this because the marketplace did not exist. This was pre-2012. Okay. And in 2012, the Jobs Act passed. And that's what allowed for syndication to really blossom. Yeah. And heretofore was all. Yeah. Heretofore, everything but prior to 2012 was the good old boy club, and you had to be somebody and know somebody, and you had to have a connection. And now you still do, but it's a very different world and a very different, the media world's landscape has changed. So anyway, I'd have these big tranches of commission checks. And I'd say, I want to be in an IPO. And my guy would be like, you're not big enough to get the IPO shares. Your account's not large enough. I'm like, well, how big has it got to be? He goes, a couple million. My account was on a couple million on liquidity. And I'm like, okay, give me some hedge fund deals. Let's get into some hedge funds. You're not a QP. What's a QP? A qualified person. You got to have a net worth of X. Oh, and then you're not accredited because the accredited rules were different back then. And so what he said to me is, David, you're Tina. I'm like, what do you mean I'm Tina? He's like, there is no alternative. I was so angry.
Were you pissed about that? Yeah, pretty angry about that. Yeah.
It's been a decade and I can still remember the conversation. Yeah. And it's part of why I founded this business. Yeah. If you have a net worth of $1 to $5 million, nobody cares about you. Brokers don't call you and say, I got the best stock known to mankind. They give you the marketplace recommendation from their analyst who's sitting behind a cubicle, who's thinking about this in academic terms only. You don't get a customized portfolio. You're not worth it to them.
What, so that's, I just love that whole narrative, the story, David. So what has been your shift, and have you taken like the mindset and some of the tactics, or all the tactics, whatever you can grab, of the super rich, the ultra high net worth, whatever you want to call that class, and brought it down to basically the sector that you feel like that many people like yourself are in?
Yes.
Is that something you've
Yes.
done?
Yeah, think about it for a second. And this is why I create the acronym SCALE. And if you bear with me for 1 second, SCALE means shelter, cash flow, appreciation, leverage, and equity. Appreciation is one of those mindset things that people don't think about. And appreciation in the general world means that something grows at a normal rate. In the commercial real estate world, we get into forced appreciation. And you think, well, that's a nice language. What's forced appreciation really mean?
Yeah.
The reality is that forced appreciation is something that you can actually impact and affect how your property is valued based on your operational performance. In the publicly traded markets,
I kind of said it again slowly, just people to kind of really absorb that.
Okay.
Hit it again.
Forced appreciation is basically a mechanism that you can predict, you can affect, and you can impact in definitive terms based on operational excellence, based on quantified hard data, and based on marketplace situational awareness and performance.
So
now, let me go into that.
A lot of stuff there, folks. Like to listen, like to just, obviously he said it twice, very specific, very actionable, and also something that typically you can know with some degree of precision. But please continue, David.
Yeah. Forced appreciation in essence means that I'm going to improve my EBITDA if you compare it to a publicly traded company. I'm going to improve my earnings before income tax depreciation and amortization. So in commercial real estate, that equals out to net operating income. How do you increase your net operating income? Well, simple math is you increase your income and you decrease your expenses.
Yes.
In residential real estate, your values are based on a comparables hypothesis. So if your neighbor down the street is a crackhead and sold their crack house for $30,000 or $80,000 or $200,000 below market, your property value just decreased.
Yeah.
If you're a commercial real estate guy and you own a multifamily property or self-storage or industrial or strip mall, and you're making $1 million in net operating income, and the guy across the street's making $630,000 in net operating income, you buy his junker because he's an idiot.
Yeah.
And he's not operating his business properly.
Yeah.
And so this is a place where you,
great incentive to perform. Like it's like the market, it's a beautiful thing that capitalism has done there, and especially in this space, it's very, very clear and direct. Do well, operate your business, keep costs down, and you will create value overnight by doing that really well. And if not, you're going to lose value compared to, if you have a direct comparison, a one-to-one comparison. It's very like, hey, they suck at operating or whatever, some other particular there in the situation.
Yeah, exactly. And it's not a little bitty incremental change. In Colorado, I also had a residential brokerage. And in Colorado, the average house has increased 6% per annum since 1950 through the ups, the downs, the goods, the bads. Okay, so you own a property for 10 years, it's going to grow by 60%, simple math. In multifamily, if you can go in, and this is what Mac Assets does. We buy a property that's under renting the market by $100, $300, $500 a unit. We put in the capital to improve that property's rental rate. That capital, by the way, is a below the line cost because that capital is not operating income. That capital is a true capital expense. It's a one-time endeavor.
Yes.
We then drive our income up and our operating costs do not measurably appreciate. In fact, often they depreciate because we've reduced maintenance. We've improved our tenant base. So this is a really simple model. And when I discovered this was an aha moment. In corporate America, you can't force appreciation in the stock market. You can create an earnings result and you let the marketplace play back to you.
Yeah.
I was in General Motors the day they came out of bankruptcy and made $1 billion profit in 2009. I was in the headquarters that day.
Wow.
And the stock went down
The day they came out of bankruptcy?
with $1 billion. Their first profitable quarter and their stock went down.
Why?
So there's not a direct correlation between EBITDA growth and share price. In commercial real estate, specifically in the deals that I work on, there is a direct correlation between operating income, net operating income, positive cash flow to asset value.
So if you like control, folks, if you like something that you have some, you can get behind the steering wheel, can use a General Motors analogy as a car or a truck, and you feel like you're somewhat directing this thing. If you don't feel, if this is too much work and you don't, you're not motivated to be in control of your financial life, then these types of things, this conversation will be boring to you and pointless. If these kinds of things are relevant for you and you feel like you want to be in control of that, which I firmly, and I'm sure David agrees, you should be in control. It's a huge, huge component of your life, your happiness, your prosperity, and your future generation. If you have kids, then these are the things that are really important, and that's why this is such a powerful concept that David has articulated so carefully as he's going through his own journey.
Yeah, and I might say, I don't know that you can control it completely, but you can definitely influence it more. And as I work with passive investors, they're truly passive in this, but they control their decision making. And I think that's the key to this for me and my clientele, is that you get to control your decision making. You get to analyze the decision. Marcus Aurelius writes, there's no theft of free will reported in his book, Meditations.
Yeah.
And I have that on my wall because I love it so much.
Yeah.
And in corporate America, there's often a theft of free will.
The analogy, just to take that further, that we can get behind the driver's seat or behind the wheel and we can chart a direction, but the analogy still works, Lisa, as far as that goes, because we can have ice on the road as people in Colorado or Minnesota. We can have traffic. So there's things that influence it. Maybe even have a car wreck. The bad things can happen. There's definitely influence. It's not just like you're like a master, you're like omnipotent. You just do whatever you want.
I'm not a deity.
Yeah. However, it is much more, you're much more in control than the stock market analogy, which is maybe, some other thing. But anyway, so yeah, it can work in some situation. But yeah, go ahead.
Yeah.
So this is awesome, man. Go ahead.
I'll never forget that in my 401k for 17 years, I was a highly compensated employee. So I was capped at what I could contribute. I could only contribute 2% above the average of the entire pool of eligible participants in the 401k plan. So I couldn't even contribute the maximum allowed by law. And then I'd get a check back at the end of the year that says, oh, by the way, here's thousands of dollars you didn't know were coming that are now taxable income. Talk about lack of control.
Yeah. And
or influence.
Yeah. You're not in control. And also, it's like when all that happens, David, and then you see the result of it, it's like, who set this thing up? Like who was the master planner for this? It set this it seems enticing when you first start at the company, and after you go along, it seems very engaging, and it's all like, hey, you're getting free money and all this kind of stuff. But then when you see some of the restrictions and some of the way it actually plays out in real life, it's like, who in God's name set this thing up? Like, this is not, that beneficial. So as we take this to the final, we'll wrap this up here, David.
Okay.
What is, give us your final parting thoughts of wisdom from the things we've talked about, and then the final little bit. How should people get in contact with you to know and learn more?
Well, thanks. So I'll do that part first. Mac Assets, macassets.com. So my final take on this is that as a highly compensated executive or entrepreneur or anybody that's making good money and is accredited, you have the opportunity to take those golden handcuffs you think you wear and make them into a lever or a fulcrum to grow net worth, to give you freedom around your decisions. And then you can make your FU money and make a decision at that point in time. And yeah, I'm launching a new podcast called Break Your Golden Handcuffs. It'll be out in a couple of weeks. And this is all what I'm talking about, is how you take structure and you lay out a portfolio, you lay out passive investments, you lay out tax strategies. It's not about how much money you make. It's about how much money you keep.
Awesome. And we're going to leave it there, folks. Thank you for listening to another episode of Investing Stuff You Should Know. We always appreciate a comment, a like, a reference, or referral to a friend. So as the show grows and we get more excellent guests like David on, we just keep continuing building on itself. So until next time, thank you, David. Hey, later.
Great time being on the show. Thanks, Johnny.